Today, we are looking at one of the most confusing but most powerful parts of investing, ETFs, what they are, and how to use them to build a simple investment portfolio you can actually maintain, even if you're busy, even if you're new, and even if you're starting with small amounts. If you ever felt overwhelmed by charts, fees, tickers, or the 10,000 different investment choices out there, breathe, because today we keep it simple and practical. So first, what is an ETF? ETFs stand for Exchange Traded Fund. Think of it like a basket that holds lots of different investments. Inside it, sometimes hundreds or even thousands of companies. Instead of guessing which one stock will win, you buy a basket that holds many. This spreads the risk and makes investing safe and easy. Simple example, option. Buy one stock, for example, Tesla, risk level, higher, effort, high, explanation, you rely on one company doing well. Option, buying an ETF with 500 companies, risk level, lower, effort, low, explanation. If one company struggles, others balance it. So ETFs equals built-in diversification, protection, simplicity, long-term growth. ETFs are basically the autopilot mode of investing. They don't require you to study companies all day, don't require timing the market, don't fall apart if one CEO messed up. We are not learning every type, just the 4 types that matter for beginners. First, stock market index ETFs. These track large parts of the stock market. Examples, S&P 500 ETF, US large companies. Total world stock ETF, global companies. Second, bond ETFs. These are more stable and help smooth out risk. Third, sector ETFs, optional. Tech, healthcare, clean energy, only if you want extra exposure. Fourth, dividend ETFs, optional, for income-focused investors. As a beginner, you only truly need the first 2, stock ETF, bond ETF. Everything else is optional. When choosing an ETF, just check these 4 metrics. First, the index it tracks. This tells you what companies are inside the ETF. Examples, S&P 500 equals 500 biggest US companies. MSCI World equals global developed companies. FTSE All World equals global including emerging markets. The index matters way more than the brand name. Second, expense ratio, fees. This is what you pay every year to own the ETF. The lower the fee, the better. Third, fund size. Assets under management. Bigger funds equals more stable, plus lower trading spreads. Look for over $500 million AUM, or regional equivalent. Fourth, domicile tax treatment. If you are outside the USA, avoid US domiciled ETFs to reduce dividend taxes. Prefer Ireland domiciled ETFs on platforms like Vanguard, iShares, Amund, HSBC. If you're unsure, just search Best ETF Broker plus country name, how to build a simple portfolio. 3 portfolio types. Choose your personality type. Portfolio type 1, super simple for people who don't want to think about investing. Portfolio, 100% total world ETF. Example ETFs, VWRA, IWDA, plus a meme combo, VT in USA. This is set and forget investing at its finest. Portfolio type 2, balanced, less volatility. Portfolio, 80% total world stock ETF, 20% global bond ETF. Works great for beginner investors, people who want steady growth. Portfolio type 3, growth focused. Portfolio, 90% stocks, 10% bonds. Best for younger investors, long time horizon, 10 plus years. How to actually pick your ETFs. Step 1, calculate how much risk you're okay with. If seeing your money drop 20% makes you panic, choose more bonds. Step 2, select stock ETFs first. Go for global stock ETFs or S&P 500 plus international mix. Step 3, add bonds only if you want smoother returns. Step 4, automate monthly contributions. Consistency beats timing always. Example, portfolio for different countries. Region, USA. Block example, Vanguard Fidelity. Stock ETF example, VTI or VOL. Bond ETF example, BND. Region, UK. Broker example, Trading 212 or Vanguard. Stock ETF example, VWRA or VUSA. Bond ETF example, VAGP. Region, Europe. Broker example, the Giro or Scalable. Stock ETF example, IWDA or EUNL. Bond ETF example, AGGH. Region, Asia. Broker example, IBKR. Stock ETF example, IWDA or VWRA. Bond ETF example, IGGH. Your portfolio shouldn't depend on where you live. Just your broker does. Real life example calculation. Let's say you invest $200 per month into a global stock ETF at 7% average yearly growth. Over 30 years, that is $244,000, even though you only contributed $72,000. Common mistakes to avoid: buying too many ETFs, chasing what's hot, checking your portfolio daily, not automating deposits, panic selling during dips. Remember, your portfolio is a long-term plan, not a short-term lottery ticket. So now you understand what ETFs are, how to choose the right ones, how to build a simple, long-lasting portfolio. Please make sure to like, subscribe, and share this with someone who needs financial clarity today. Also, please watch our next video here. Thanks for watching.